Welcome to Group 6's Financial Position Analysis for Griffin Hospital for the fiscal years 2013 through 2016, with research compiled by Olga Carantoni, Moreno Polisano, and Joshua Wells. In the last decade, since the passage of the Affordable Care Act, greater pressures have been placed on healthcare providers and institutions to continue to provide quality care to their respective communities. Community hospitals, like Griffin Hospital in Derby, Connecticut, are particularly feeling this pressure. They are being faced with the challenge of lower reimbursement rates while struggling with diminished patient volumes, which in turn places them in a crisis-level fiscal cycle that in turn requires a comprehensive, hospital-wide, strategic financial plan to ultimately maintain viability and solvency. On this slide, we see the struggling total margins experienced at Griffin Hospital from the years 2013 through 2016. This trend was consistent with statewide trends seen over the same time period, suggestive perhaps of similar cost and reimbursement rates experienced statewide. In 2016, however, Griffin Hospital demonstrated a significant improvement in performance with a 5.75 total margin return, an essential 6-point swing from the year prior, and even surpassing the statewide median benchmark. Operating margins represent the success or failure of a hospital's core operations, essentially the business they are out to perform. Operating at negative margins, as was noted in 2013, is not sustainable for long. Through 2015, Griffin is operating at margins below the statewide median, but in 2016, a significant healthy reversal was noted, in line with total margin. Assuming cost and reimbursement changes are consistent with its statewide counterparts, such an improvement in operating performance is likely due to internal management improvements and efficiencies. Another important and insightful point to make here surrounds understanding the components of a hospital's profitability. Although operational performance is critical to long-standing viability, it only contributes approximately 30% to a hospital's overall profitability. Non-operating revenue, which accounts for only approximately 5% of revenue, ultimately contributes approximately 40% to overall profitability. Griffin Hospital's non-operating segments operated at a loss in the years 2014 through 2016. Correcting for such losses could have had an impressive overall effect on total profitability. Griffin Hospital's return on assets and return on equity trends show similar marked improvements in the period 2015 to 2016 in particular. It had a 9-point reversal in return on assets from 2015 to 2016 when its ROA peaked at 8.66%. The intuitive understanding of the return on equity figures are a little less clear, partly due to Griffin's negative equity values in this time period. We must remember that equity in nonprofit organizations are different than the equity we see and interpret with investor-owned businesses. If we follow the trend and sign of net income to interpret this metric, net income has a powerful reversal from an estimated negative $500,000 in 2015 to a positive $10 million in fiscal year 2016. Liquidity, or the ability for an organization to raise cash and such equivalents to cover its short-term debt obligations, is another metric of fiscal health. The current ratio looks at total current assets to current liabilities, and here we see Griffin Hospital performing below statewide levels. Some argue, however, that looking at days cash on hand is a more appropriate metric, and if we look at this metric for Griffin Hospital, we see consistently higher levels across this 4-year time frame in comparison. Although there is no magic benchmark to obtain, this value will vary based on region, payer mix, and further indicators. However, all stakeholders clearly want a hospital that is able to efficiently and swiftly cover its expenses on a day-to-day basis. Moving along, we have Griffin Hospital's debt management. To give a quick overview, a debt ratio is the amount of a company's assets that are provided through debt, while the debt to capitalization ratio further elaborates on this. For both of these ratios, anything over 0.5 or 50% tend to show that organizations fund their assets primarily through debt. These debt ratios serve to establish an organization's leverage, which gives investors a sense of how risky an investment may be. An organization with higher leverage is riskier than one with low leverage. As noted in the graphs above, Griffin Hospital's assets are largely funded by debt compared to the Connecticut median, as can be noted by ratios of well over 1.0 and 100%. Expanding on the principles of leverage from the previous slide, a long-term debt to net assets ratio serves to demonstrate the ability of a company to meet its financial obligations, and within that, how much monetary debt exists per dollar of assets. For Griffin Hospital, paralleling the earlier debt management ratios, it can be observed above that the vast majority of their assets are funded via debt. Though this may seem paradoxical, some investors prefer these highly leveraged ratios, for it ensures an organization securely pays its debt rather than the financial institution tying their outcomes to purely profit and revenue driven by the hospital. Delving into Griffin Hospital's asset management ratios allows for us to see how effectively their assets are being utilized within their healthcare system. What all of the above asset ratios serve to do is to show the amount of revenue Griffin Hospital generates through their assets, with distinctions being fixed asset turnover ratio, concerning primarily property, plant, and equipment, current asset turnover ratio, being more short-term liquid assets, and total asset turnover ratio being as its name lends. All are consistently above the Connecticut state median when comparison data is applicable, indicating a certain level of efficiency from Griffin Hospital as compared to other area hospitals and systems. These ratios serve to balance out the debt management ratios in the sense that Griffin Hospital is able to efficiently generate revenue on their assets to pay down the debts they incurred to gain said assets. Expanding more on Griffin's trend of increasing productivity on their assets, above is their revenue generated per full-time employee as compared to the Connecticut median. As we can see that while the Connecticut median is higher, Griffin's trend is largely the same. This is an impressive indicator owing to the fact that Griffin is an independent hospital, while a number of the other Connecticut state hospitals are organized into health systems and networks and therefore have larger populations. For some perspective on these numbers, Griffin has just over 900 employees, while Yale New Haven Health System and Hartford Healthcare number in the tens of thousands of full-time employees. Serving as a foil to the information provided in the earlier debt management and asset turnover ratio slides, it can be observed that a low amount of Griffin Hospital's assets are financed through stockholder equity of any kind. While the state of Connecticut median data is not available for this particular indicator, it would not be far off to assume that, like the graphs in the preceding slides, that the trend curve would be in the opposite direction from Griffin Hospital due to their large amount of asset being funded through debt. Furthering Griffin Hospital's homegrown productivity efforts is its ratio for average days in patient account receivables, which establishes how efficient the hospital is in collecting its charges measured in days. As evidenced in the graph above, Griffin Hospital has improved upon its collection times by nearly a week and a half, which can be a positive from an investor standpoint. This lower number of days also shows that Griffin can more aggressively pay off its debt if the trend continues in a positive fashion. However, in balancing out Griffin's positive trends, something that may serve as a hindrance to them is their average age of plants, which in this case is their healthcare facilities and equipment. If you look at the graph above, the average age of plants increases nearly 7 years over the 4-year span observed, showing that a major facilities investment may be needed to curtail aging assets and property. Given Griffin Hospital's debt burden, this may be a dilemma due to existing debt-financed assets. Lastly, we observe Griffin Hospital's uncompensated care costs versus those of the state median. While these numbers are difficult to parse apart, there seems to be a general downward trend with them for both Griffin and the Connecticut median. This trend can be due to several factors such as increased insurance coverage throughout the state due to the Affordable Care Act, or the fact that people are farther removed from the Great Recession and therefore are more able to spend on their health. However, with only quantitative information, we cannot accurately assess any sort of qualitative narrative, and anything else is simply assumptions. Summarily, what does all of this mean for Griffin Hospital? For the community and employees, a certain level of optimism and pride should be held due to Griffin Hospital's productive turnover on their assets, the net revenue generated per full-time employee, and their improving turnaround time on collecting account receivables, which all subsequently means they can successfully pay down liabilities propping up their assets. Moving up the ladder, the board of directors and involved financial institutions can share the same optimism, but a few indicators must be watched carefully, chiefly the massive debt burden behind their assets and their aging facilities and equipment that may further load debt onto them. Overall, these 4 years paint a positive picture for Griffin Hospital, so it'll be interesting to see where these trends carry them. Thank you for taking the time to listen to our presentation. We hope it was as informative for you as it was for us researching it.